There's a specific number sitting in federal law right now, and the moment your bank account crosses it, a report gets filed with the federal government. No letter, no phone call, nothing. And here's what almost nobody tells retirees. The instinct most people have the moment they learn this number exists is actually a federal felony. I'm Dr. James, and today's video is one of the most important ones we've done, especially if you're one of the 3.1 million people who recently received a Social Security Fairness Act back payment. Quick recap, because today's topic connects directly to it. We told you that over $17 billion in retroactive Social Security payments went out to public sector retirees and their spouses after the windfall elimination provision and government pension offset were repealed. If you got one of those payments or any other large lump sum, a pension payout, an inheritance, proceeds from selling a home, today's video is about protecting that money the right way. Here's what we're covering. First, the actual $10,000 rule and what it does and doesn't apply to. Second, a second, more important report that has no dollar threshold at all. Third, the one instinct that turns a completely legal situation into a federal crime. Fourth, exactly how to deposit a large payment so it never becomes a problem. Let's start with the number itself. Under the Bank Secrecy Act, every bank and credit union in the country is required to file what's called a Currency Transaction Report, or CTR, with the Treasury's Financial Crimes Enforcement Network anytime a customer's cash transaction exceeds $10,000 in a single business day. I want to be precise here, because this is where a lot of confusion happens. This rule is about physical cash and certain cash equivalent instruments like money orders. It does not apply to a direct deposit, a regular check, or your Social Security payment landing in your account electronically. If your SSA back payment arrived as a direct deposit, this specific rule was never triggered in the first place. This mostly matters for cash sales, selling a car, for example, or converting a large cash gift into your bank account. One detail that catches people off guard: banks add up your cash transactions across the entire day, even across different branches. Depositing $5,000 at one branch and $6,000 at another that same afternoon still totals $11,000, and it still gets reported. You cannot get around the threshold by splitting locations on the same day. Now here's the part I really want you to understand. A currency transaction report by itself is not an accusation. It is not a red flag.
It is mandatory paperwork. Banks file millions of these every single year, and the overwhelming majority trigger absolutely nothing. The report itself is not the danger. What comes next is where things can go wrong. That brings us to the second report, and this is the one almost nobody explains because it doesn't have a dollar threshold at all. It's called a Suspicious Activity Report, or SAR, and a bank can file one on a transaction of any size, even a few $100s, if their internal compliance software flags a pattern. Not a crime, a pattern. And the pattern that trips a SAR fastest is a series of deposits that added together would have crossed $10,000. In other words, the exact thing some people try to do specifically to avoid the first report is the exact thing that triggers the second one. Let me walk through a hypothetical situation because it makes this concrete. Picture a retired teacher, we'll call her a composite example, not a real person, who received an $11,000 Social Security Fairness Act back payment. She'd heard somewhere that $10,000 was some kind of government line, so she deposited $5,000 on a Tuesday and $6,000 on a Friday at the same bank. Her own money, a completely legitimate government payment, but the bank's monitoring software saw two large deposits in the same week landing in an account that had never held more than a few $1,000s, and it filed a SAR. She did nothing wrong, but that report now sits in a federal database. And here's the detail that makes this especially frustrating. The bank is legally prohibited from telling her it happened. A bank employee who tips off a customer about a SAR commits a separate federal crime, punishable by up to 5 years in prison. So the silence isn't an oversight, it's the law.
The retirement timeline is circled and flagged with variation detected.
This is exactly why retirees get flagged more often than working-age account holders, even though they're doing nothing wrong. When you're employed, your money moves in one predictable shape, the same paycheck, the same schedule, month after month. Retirement income doesn't work that way. Social Security lands on one date, a pension on another, and then on top of that, occasional large one-time events, a required minimum distribution, a home sale, a retroactive government payment. Monitoring systems are built to notice variation, and a retiree's financial life is naturally more varied than a single steady paycheck. None of this means anything is wrong with how you're handling your money. It just means the system was built around a more uniform pattern than retirement income actually follows. Now let's get to the part that matters most, the one instinct that turns all of this into an actual crime. When people learn about the $10,000 rule, the first thought is almost always the same: keep deposits under it. Split it up a little, today, a little next week. That instinct is not a workaround. It's a federal felony called structuring under Title 31 of the U.S. Code, Section 5324. It is illegal to break up a transaction specifically for the purpose of avoiding that reporting requirement. Your money doesn't have to be illegal. You don't have to be laundering anything. If every dollar you have is completely legitimate, earned, inherited, or paid to you by the government, and you deliberately deposit it in smaller pieces specifically to stay under $10,000, that is a federal offense. The penalties are serious. Structuring under $100,000 in a 12-month period carries up to 5 years in federal prison and fines up to $250,000. Above $100,000, or if it's tied to another crime, the penalty rises to up to 10 years. And critically, the government can seize the money through civil forfeiture before any conviction happens at all, which means the burden falls on you to prove the money was legitimate while the money is already gone. Here's why I want to be fair about this, rather than just scare you. The Treasury's own Inspector General studied this. Back in 2017, an audit by the Treasury Inspector General for Tax Administration reviewed structuring seizure cases and found that in 91% of cases where the source of funds could be determined, the money had been earned completely legally. The law was written to catch drug traffickers and money launderers. In practice, it was overwhelmingly affecting ordinary, honest account holders, small business owners, retirees, people who simply didn't know the rule existed. That finding led to real reform. In October 2014, the IRS Criminal Investigation Division changed its policy, so it would no longer pursue seizures in these legal source cases, except in exceptional circumstances, and Congress held hearings that pushed for further protections afterward.
But structuring itself is still very much a crime on the books today. The lesson hasn't changed. Never break up a deposit specifically to dodge that line. So let's get to what you should actually do. Because the answer isn't to avoid the bank, and it isn't to keep cash at home either. Cash sitting in a house isn't insured, it earns you nothing, and it creates its own problems if you're ever asked where it came from. The real answer is documentation, not avoidance. Here's your action plan. Step 1. Before you deposit any large sum, gather whatever documentation proves where it came from. Your SSA award letter or back payment notice, a pension distribution letter, an estate settlement letter, or a bill of sale if you sold something. Step 2. Deposit the full amount in a single transaction. Never split it across days or branches to stay under a threshold. Step 3. Hand that documentation to the teller in person and ask them to note the source on the transaction. You are allowed to do this, and it's one of the simplest ways to protect yourself. Step 4. Keep a personal file, physical or scanned, of every supporting document for any deposit over $5,000. Step 5. If you're required to take a minimum distribution from a retirement account and your plan allows it, consider spreading it across smaller scheduled amounts throughout the year rather than one large lump sum in December. A routine scheduled distribution reads completely differently to a monitoring system than one unexplained large deposit. And step 6, the most important one, never, under any circumstance, break up a deposit specifically to stay under $10,000. A large, legitimate, fully documented transaction is completely fine. Trying to dodge the report is the only thing that's actually dangerous. One more practical note, especially relevant if you're gifting some of that back payment to family. The annual gift tax exclusion for 2026 is $19,000 per person. You can give up to that amount to as many people as you'd like without filing anything with the IRS. Go over that to any one person in a year, and you're generally required to file a form, though it usually doesn't mean you owe tax, it just counts against your lifetime exemption. Keeping a simple written record of any larger family gifts protects you either way. Let's bring this together. A currency transaction report is routine paperwork, not an accusation. A suspicious activity report has no dollar floor and gets triggered by patterns, not crimes. Structuring, breaking up a deposit to dodge the report, is a real federal felony, even with completely legal money. And the actual protection is simple. Deposit the full amount at once and bring the paperwork that explains where it came from. Tomorrow, we're covering something just as important and directly connected. What actually happens to that same money if something happens to you before you spend it? There's a specific free bank form that determines whether your family can access your account within days or whether it gets frozen in probate for over a year. Most people have never filled it out, and most people have no idea it exists. If today's video helped you avoid a mistake you didn't know you could make, hit subscribe and turn on notifications. Drop a comment if you've had a large deposit questioned by your bank. I'd like to hear how it was handled. See you tomorrow.
Since we're already talking about protecting your money today, I want to cover two more things before we close out, because both of them are just as urgent as everything we've already discussed, and one of them directly follows up on something I promised you a few days ago. First, an update on Social Security overpayments, because this policy has changed 3 times in the last 2 years, and a lot of retirees are confused about which rule actually applies to them right now. Here's the timeline, quickly. In March 2024, under the previous administration, the withholding rate for a new overpayment was capped at just 10% of your monthly benefit. In March 2025, that reversed sharply. The agency announced it would go back to withholding 100% of your entire monthly check until the overpayment was repaid. That triggered enough public backlash that just a month later, on April 25, 2025, the agency settled on a middle ground, a default withholding rate of 50% of your monthly benefit for any new overpayment notice. That 50% default is still the rule today, heading into the second half of 2026. Here's what that means in practice. If you get a letter saying you were overpaid, the agency will wait at least 30 days before it starts withholding anything. If, within that 30-day window, you request a waiver or file an appeal, the agency will not collect a single dollar while your request is being reviewed. If you do nothing, withholding begins automatically at 50% of your monthly benefit, continuing until the full amount is recovered. Supplemental security income overpayments are handled separately and remain capped at 10%. That part hasn't changed. You have 3 real options if this happens to you, and it's worth knowing all 3, because a lot of retirees only know about one. You can request reconsideration if you believe the overpayment amount is wrong or that no overpayment happened at all. You can request a waiver if you agree the overpayment happened, but paying it back would cause financial hardship or wasn't your fault. And even if neither of those applies, you can simply request a lower withholding rate, even as low as a small monthly amount if 50% would be too much for your budget to absorb. Let's put real numbers on this so it's not abstract. Say your monthly benefit is $2,000 and the SSA determines you were overpaid $6,000 over the past year because of a delayed update to your record after a spouse passed away. Under the current default rule, the agency would withhold $1,000, 50%, from your check every month until that $6,000 is recovered.
which is 6 months of cut-in-half payments. If that would leave you unable to cover rent, medications, or utilities, that's exactly the situation a waiver or a reduced rate request is designed for.
You do not have to just accept the default number on the letter. Reach out before the 30 days pass. According to the Social Security Administration's own Inspector General, the agency issued roughly $71.8 billion in improper payments, mostly overpayments, between 2015 and 2022, and the overwhelming majority of those errors came from the agency's own processing mistakes or delays in updating records, not from anything beneficiaries did wrong. So if you get one of these letters, please don't assume it's your fault, and please don't assume you have no options. Call the SSA at 1-800-772-1213 or visit your local field office and ask specifically about reconsideration, waiver, and rate reduction. All three by name in that same call. Now, the second thing, and this one ties directly back to the structuring and banking topics we covered earlier today, because scammers specifically target the exact fear we just spent the last several minutes discussing. The SSA's Office of the Inspector General has issued several fresh warnings this year, and I want to walk through the newest ones because they're more sophisticated than the scams from a couple of years ago. In February 2026, the OIG warned about a sharp rise in emails that look exactly like official Social Security correspondence, telling you that a new Social Security statement is ready for you to download. These emails use real SSA logos, real formatting, and sometimes even the names of actual SSA employees. Clicking the link inside doesn't get you a statement. It can install malware on your device or send you to a fake site built to steal your Social Security number and banking details. There's also a mail-based version of this making the rounds, a letter styled to look exactly like it came from Social Security, telling you that your cost of living increase for the year has been approved, but that you need to activate it by calling a phone number or scanning a QR code printed on the letter. I want to be absolutely clear about this one. Your COLA increase is completely automatic. It requires no phone call, no QR code scan, and no action from you whatsoever. If a letter tells you otherwise, it did not come from Social Security. And the phone version, which has been around longer but is still extremely common, a caller claims your Social Security number has been suspended or linked to criminal activity, creates immediate panic, and then demands payment, often through gift cards, wire transfers, or apps like Zelle or Cash App to reinstate your number. Sometimes the caller ID is spoofed to display a real government phone number. The Social Security Administration has stated plainly and repeatedly, it will never suspend your Social Security number, it will never threaten you with arrest, and it will never ask you to pay with gift cards, cryptocurrency, wire transfers, or by keeping the call secret from your family. The scale of this is worth knowing too. According to the Federal Trade Commission, government impersonation complaints rose about 25% in 2025 alone, topping 330,000 reports. And the Social Security Administration remains one of the most frequently impersonated agencies in the country. I also want to flag one newer twist on this that's specifically worth knowing about if you have grandchildren.
Regulators have documented a rise in scammers using AI-generated voice cloning, often paired with these same impersonation tactics to imitate a family member's voice in a panicked phone call asking for emergency money, sometimes layered right on top of a fake official call about your Social Security account to make the whole scenario feel more urgent and more real. If you ever get an unexpected, panicked call asking for money, whether it claims to be a grandchild or a government agency, the same rule applies either way. Hang up and call back using a number you already have on file yourself, never one the caller gives you. Here's how to protect yourself, and this list is short on purpose so you actually remember it. 1. Social Security typically only calls you if you've recently applied for a benefit, are already receiving payments and need a record updated, or you specifically requested a callback. Outside of those situations, an unsolicited call claiming to be from the SSA should be treated as suspicious by default. 2. If there's a genuine issue with your Social Security number or record, the agency's standard practice is to notify you by mail first, not by a threatening phone call demanding instant payment. 3. Never trust caller ID alone. Spoofing a government number is trivial for scammers to do.
4. Set up and regularly check your own account at ssa.gov/myaccount so you can verify your own information directly rather than through a link someone sent you. And 5. If you ever do share information with a scammer, report it to the SSA's Office of the Inspector General, the FTC, and place a fraud alert with the 3 credit bureaus right away. Let's bring everything from today together because we covered a lot of ground. A currency transaction report on a large deposit is routine paperwork, not an accusation. But breaking up a deposit to dodge that report is a real federal felony called structuring, even with completely legitimate money. If you ever get an overpayment notice, you have 30 days to request a waiver, an appeal, or a lower withholding rate, and the default is now 50%, not 100%. And this year especially, watch for scam emails offering a Social Security statement download, letters demanding you activate your COLA, and phone calls claiming your Social Security number has been suspended. None of those are real, and none of them require your immediate action. Tomorrow, we're moving from protecting your money while you're here to protecting it for your family after you're gone. There's a specific, completely free bank form that determines whether your family can access your account within a few days of your passing or whether it gets frozen in probate for over a year, even with a will in hand. Most retirees have never filled it out, and most have no idea it exists. If today's video helped you feel more confident about a letter, a call, or an email you've received, hit subscribe and turn on notifications. I cover something new like this every day. Drop a comment if you've ever gotten one of these scam calls or letters yourself. I read every one. See you tomorrow.